closes an open call option position by taking ownership of the underlying stock. If a trader wants to exercise a long bought stock option, the broker is notified, who then notifies the OCC. By the next business day, the account will own, if exercising calls, or have sold, if exercising puts, the corresponding shares of underlying asset or, in the case of index options, will transfer cash. An option seller cannot exercise an option. By selling an option, the trader is taking the risk of having an assigned buyer exercise the option. The OCC randomly matches or assigns buyers and sellers to one another. If there is an excess of sellers by expiration, all open position ITM short options are automatically exercised by the OCC. In order to avoid being assigned, short option holders can offset or close their options instead. Anticipating assignment selling puts or calls involves significant risks. However, some strategies carry relatively low risk, but also involve selling options. For example, a strategist might buy a call and sell another call with a higher strike price, a position known as a bull call spread. In that trade, which is discussed in more detail in Chapter 5, the long call covers the short call. That is, if the short call is assigned, the long call can be exercised to satisfy assignment. Sometimes we want to sell options. But if an option is sold, how does one determine if there is a risk of assignment? While there is no way to know for certain if and when assignment will occur, there are ways to anticipate it before it happens. Recall that sellers take on an obligation to honor the option contract. Therefore, a call writer agrees to sell the stock at a predetermined price until the option expires. Similarly, the put seller has the obligation to buy the stock, or have it put to him/her at the option strike price until the option expires. When a writer fulfills the obligation to buy or sell a stock, he has been assigned. Assignment is the process of buying or selling the underlying asset in accordance with the terms of the options contract. For stocks and ETFs, this involves the transfer of shares. For indexes, assignment involves cash. Once assigned, the option seller has no choice but to honor understanding options 57. 58. The index trading course. The contract. It is too late to try to buy the option contract back and close the position. Although option sellers have an obligation to buy or sell a stock at a predetermined price, assignment will only take place under certain circumstances. How do you know if you are at risk of being assigned? First, exercise generally takes place only within the money options. Recall that a call option that has a strike price below the price of the underlying index is ITM. If an ETF is currently trading near $55, the March 50 call options will have an intrinsic value of $5 because the option buyer can exercise the option, buy shares for $50, immediately sell them in the market for $55, and realize a $5 profit. A put option, by contrast, will be ITM when the stock price is below the strike price. It is rare for assignment to take place when options are not ITM. As noted earlier, if an option is in the money at expiration, assignment is all but assured. In fact, the OCC automatically exercises any option contract that is ITM at expiration. That is, options that are in the money by 0.25 or more are subject to auto exercise. The second important factor to consider when assessing the probability of assignment is the amount of time value left in the option. When an option is exercised before expiration, it is known as early exercise. In general, if there is sufficient time value, i.e., 0.25 or more, left in the option will usually not be exercised. Option sellers can expect assignment when the option has little to no time value remaining. Since the time value of an option decreases as time passes, the probability of early exercise increases as the expiration date approaches. To determine the amount of time value remaining in a call or put option, traders can use the following formula. Call time value equals call strike price plus call option price, stock price. Put time value equals stock price plus put option price, strike price. Finally, this discussion of assignment applies to American-style options. American-style options can be exercised at any time prior to expiration. However, European-style options can only be exercised at expiration. Most index options settle European-style. Options on stocks and ETFs exercise American-style. Therefore, stock option sellers can be assigned any time before the option expires. Anticipating assignment is a very important factor when using strategies that involve selling option contracts. In sum, the probability of assignment increases as 1. The option moves in the money and 2. The time value of the option drops below 0.25. There are odd times that assignment will take place with slightly out-of-the-money options or options with time value remaining. These are the exception, however, and relatively low probability events. Unique characteristics of index options. Although stock options were standardized and began trading in 1973, index options didn't emerge until 10 years later. The CBOE listed options on the S&P 100 index $OEX on March 11, 1983. As we saw in Chapter 2, the number of tradable indexes has mushroomed since then. For example, in the late 1990s, the American Stock Exchange developed and listed options on exchange-traded funds, including the popular NASDAQ 100 Index Trust QQQQ. Over the years, other contracts have surpassed the OEX in terms of popularity. So, although it was the first index with listed options, today many traders prefer to trade the DJX, QQQQ, or SPY. Indeed, option volume on the once popular index has been declining steadily over the past few years. In 2001, in an effort to renew interest in OEX trading, the Chicago Board Options Exchange launched options on a different version of the S&P 100 under the symbol XEO OEX backwards, which are different from OEX options in one important way. Like stock and ETF options, OEX options settle American style. This means that exercise can take place anytime prior to expiration. Most indexes, excluding a handful, settle European style, meaning exercise can take place only at expiration. Many option traders do not like the risk of early exercise when dealing with cash settlement. For instance, the threat of early exercise greatly increases the risks associated with the short side of credit spreads discussed in more detail in Chapters 5 and 6. Given the demand for index options with the European-style exercise feature, the CBOE announced the launch of the European-style S&P 100 options on July 23, 2001. Like the OEX, the index options are based on the value of the S&P 100 index, but exercise can only take place in a specific period of time shortly before expiration. In other words, XEO settles European style. According to a CBOE press release, CBOE created the new Understanding Options 59 assignment, a notice delivered to the option seller requesting him/her to fulfill the terms of an options contract, which includes delivering the underlying security for a call writer or accepting delivery of the underlying asset for a put seller. Product, XEO, in response to customer requests for an S&P 100 index option that does not carry the possibility of early assignment. So another consideration when looking at an index options contract is whether the options settle American or European style. Most sector indexes settle European style, but not all. Table 4.2 lists a variety of indexes, their ticker symbols, the exchange where the options trade, and whether the options settle European or American style. As you can see, most sector indexes have options that settle European style, but not all. This table provides a summation of the more interesting sector indexes. Simply looking at the name of the index will tell what specific industry group the index represents. For example, the Amex Airline Index is an index consisting of airline stocks, no surprises there. 60 THE Index Trading Course, CBOE announces new S&P 100 index options with European-style exercise XEO, to launch July 23, 2001, CBOE press release www.cboe.com July 13, 2001. Where do index options trade? Today, equity options trade on 6 U.S. options exchanges with the following 4 also active in index option trading: American Stock Exchange Amex, Chicago Board Options Exchange CBOE, Philadelphia Stock Exchange PHLX, International Securities Exchange ICE. These 4 exchanges list index options and create new contracts based on investor demand. In addition, product specifications for index option contracts can be found on their websites amex.com, cboe.com, phlx.com, and iseoptions.com, respectively. Figure 4.1 breaks down total stock and index options volume by exchange. The ICE and CBOE do most of the business. However, the Amex, PCX, PHLX, and BOX also handle a large amount of options trading. Market share by exchange will change over time based on a myriad of factors including products listed and technology upgrades. Understanding Options 61 Table 4.2 Sector Indexes Sector Index Symbol Exchange Settlement Style The Dow Jones Utility Average DUX CBOE European PHLX Bank Sector Index BKX PHLX European PHLX Box Maker Index BMX PHLX European Amex Biotechnology Index BCOMEX European MS Consumer Products Index CMRAMEX European MS Commodity Related Index CRXMX European MS Cyclical Index Psychomex European Amex Disk Drive Index DDX Amex European PHLX Defense Sector Index DFX PHLX European PHLX Street.com Internet Index.PHLX European Amex Pharmaceutical Index Dr. Gamex European PHLX Fiber Optics Index FAPHLX European PHLX Forest and Paper Index FPP PHLX European GSTI Computer Hardware Index GCBO European GSTI Computer Software Index GSOCBO European CBOE Internet Index INX CBOE European MS Oil Service Index MGOCBO European MS Biotechnology Index MVB CBOE European MS Retail Store Index MVR CBOE European PHLX Oil Service Index OSX PHLX American PHLX Semiconductor Index SOX PHLX American DJ Transportation Average DTX CBOE European Amex Airline Index X Alamex European PHLX Gold Mining Index XOP HLX American Amex Broker Dealer Index XB Damex European Amex Natural Gas Index X and GameX European Amex Oil Index XOI Amex American PHLX Wireless Index YLSPHLX European. 62. The Index Trading Course. Options Volume by Exchange. Pacific Stock Exchange. Philadelphia Stock Exchange. International Securities Exchange. American Stock Exchange. Boston Stock Exchange. American Stock Exchange. Boston Stock Exchange. Chicago Board Options Exchange. Figure 4.1 Total Volume by Exchange. Most active by options volume. Chicago Board Options Exchange. International Securities Exchange Philadelphia Stock Exchange. Pacific Stock Exchange. For the options trader, another item to consider when studying sector indexes is the liquidity of its options. Some sector indexes do not have any options linked to their performance at all. Others have option contracts available, but the options see little trading activity. For instance, many of the sector indexes that trade on the American Stock Exchange suffer from a lack of investor interest, trading volume, and, hence, liquidity. All else being equal, the greater the trading volume and open interest associated with a sector index, the better it is for implementing trading strategies. Generally, when trading chip stocks, the semiconductor HOLDRs (SMH) are probably superior to the PHLX Semiconductor Index $SOX because the SMH sees a great deal more trading activity. Of all the index and exchange-traded funds, the QQQQ holds the position for today's most actively traded options contracts. Table 4.3 lists the top 10 indexes in terms of options trading volume. The S&P 500 $SPX and the Nasdaq 100 Index $NDX are among the more heavily traded. The Semiconductor HOLDRS and the iShares Small Cap Fund (IWM) are also among the more actively traded index options contracts. Making sense of cash settlement. When it comes to settlement, there are two different types of options: cash-settled options and physical delivery options. Stock options are an example of the latter. Specifically, an owner of a call option has the right to receive delivery of a physical asset, a stock. The owner of a put stock option has the right to sell 100 shares of stock per option contract. Exchange-traded funds also settle for the physical delivery of shares. Index options, however, do not involve the physical delivery of an asset because it is not possible to buy and sell an index. Instead, cash-settled calls and puts give the owner the right to receive cash. In order to determine how much, if any, cash the option holder is entitled to receive, one must consider the relationship between the exercise settlement value and the strike price of the option. Let's consider an example using the PHLX Gold and Silver Mining Index (ZAO) to see how cash settlement works. The Gold and Silver Mining Index (ZAO) is one of the more actively traded sector indexes. It tracks a basket of gold mining stocks and is considered a tool for playing trends with respect to the price of gold. However, the relationship between the ZAO and gold is not perfect. Understanding Options 63 Table 4.310 Most active indexes by options trading volume index symbol Nasdaq 100 index trust QQQQ S&P 500 SPX Russell 2000 small cap fund IWM Nasdaq 100 NDX Semiconductor HOLDRS SMH Mini Nasdaq 100 Index MNX Dow Jones Diamonds DIA S&P 100 OEX Select Sector Energy XLE Dow Jones Industrial Average DJX Exercise Settlement Value, the value of the index at the time of expiration. Exercise settlement amount. The difference between the exercise price and the exercise settlement value of an index on the day the exercise notice is tendered, multiplied by 100. 64. The index trading course. Nevertheless, suppose the strategist is bullish on the index, thinks it will be above $95 by September, and decides to buy 5 of the September 85 calls for $7.50 per contract. The cost of the trade is $3,750, $7.50 times 100 times 5 plus commissions. The break-even for the call position is 92.50, 85 strike price plus $7.50. Therefore, at expiration Saturday after the third Friday of September, the exercise settlement value must be above $92.50 for the calls to yield a profit. If, at that point, the index options are exercised, the owner of the calls will receive cash equal to the difference between the strike price and the exercise settlement value. Let's assume the ZOW rises to 95 and, therefore, exercise settlement value less strike price. Difference cash payment 95, 85, $10. The profit from the position would equal amount received 5 contracts times 100 times $10. Less cost of calls. Profit. $5,000. $3,750. $1,250. If the index fails to move above the break-even 92.50, the position will not yield profits. The maximum loss will occur at 85 or less, because at that point, the call options will expire worthless. Importantly, ZOW options can be exercised any time prior to expiration. That is, ZOW options settle American style. The options do not have to be held until expiration, and the position can be closed at any time by selling the same number of calls with the same strike price and expiration date, 5 ZOW September 85 calls. However, keep in mind that most index options settle European style and, therefore, can only be exercised at expiration. ZOW is an exception to that rule. Put contracts work the same way. As we have seen, when a cash-settled option is exercised, the amount of the cash payment is equal to the difference between the exercise settlement value and the strike price of the index option. With a cash-settled call, the owner has the right to receive cash if the value of the underlying index at expiration, the exercise settlement value, exceeds the exercise price of the option. In contrast, the put owner has the right to receive a cash payment if the exercise settlement value is less than the option strike price. In order to determine the value of a cash-settled option at expiration, one must first consider the exercise settlement value and the strike price of the index option. The underlying asset price is, of course, simply the value of the index and can be found at any time by pulling up a quote. B. 65. Understanding options. Exercise settlement value is generally determined on the last business day prior to expiration and is based on the first opening reported sale price for each component stock within the index. Expiration is the Saturday following the third Friday of the expiration month, but the last day to trade index options is often the Thursday prior to expiration. There are exceptions, however. For that reason, prior to entering a trade, the index strategist wants to carefully consider the contract specifications, including how and when the index settlement value is computed, the last day for trading the options Thursday or Friday, whether the index options settle American or European style, weeklies. In October 2005, while we were writing this book, the Chicago Board Options Exchange launched a new type of index contract called weeklies. The new contract has a short life of only 1 week. It is listed on Friday and expires the following Friday. The first weekly was an option on the S&P 500 index $SPX. This new short-term contract allows strategists to place short-term trades on the stock market. For instance, traders expecting the stock market to rally throughout the week might buy SPX weekly calls on Monday and then sell them before expiration Friday. Additionally, strategists worried about a market slide can buy puts on the index and then close the position at a profit if the market tanks. Since the weekly options have such a short life, they will have relatively little time value in the options contract. In addition, any time value that exists on the first Friday when the weekly is listed will quickly erode due to the impact of time decay. Remember, options with only a few days left until expiration see a greater rate of time decay when compared to longer-term options. This can create opportunities, as well as challenges, which are discussed in more detail later in this book. EXPIRATIONLESS options. Not too long before weeklies arrived, the Philadelphia Stock Exchange started trading expiration-less options, or XPOs for short. XPOs are similar to American-style options in that they come in the form of both calls, the right to buy, and puts, the right to sell, and can be executed by the buyer at any time. They do not, however, have an expiration date. They have various strike prices just like an American-style option, and the premium is based on the same factors: type of option, strike price, price of the underlying asset, volatility of the underlying asset, and the risk-free interest rate. XPOs form a bridge between the expiring and non-expiring markets. They provide for the equitization of futures contracts because the XPO provides the right to buy or sell without the dual liability of futures contracts or the expiration and delivery risk associated with these products. Hence, XPOs provide all the benefits of an option contract without the risk of expiration. They also offer a reduction in trading costs by eliminating the market inefficiencies that exist when options or futures contracts need to be rolled over. Therefore, XPOs really are expiration-less. You can find out more about XPOs at www.xpotrade.com. Index futures versus options futures are agreements to take delivery of for the futures buyer, or to deliver for the seller an asset at some point in the future. Stock index futures contracts expire quarterly in March, June, September, and December. Futures traders can go long or short futures contracts. For example, a speculator expecting the S&P 500 index to move higher can buy S&P 500 futures. A hedger looking to protect a portfolio from a move lower in the S&P can sell short S&P 500 futures. One important characteristic that differentiates futures from options is that, with futures, no money changes hands when the futures contract is established. As a result, when an investor goes long or short a futures contract, the amount of funds required in the account will equal the margin requirements. Then, at the end of each trading day, the account will be marked to market and funds will be added or subtracted from the account depending on the final value of the position at the end of the trading day. Futures and options on futures can also be used to trade the index market. Many of the ideas presented later in this book can be implemented using futures and futures options. However, futures contracts are regulated separately from stock and index options and therefore require a separate type of trading account. The focus of this book and our earlier books is not on futures and options on futures, but rather on options for stocks, indexes, and exchange-traded funds. A link to a list of brokers that provide trading accounts for the stock and index option contracts is given in Chapter 16. 66 The Index Trading Course. Quotes, symbols, and chains. Option quotes and chains are tools that traders use to find prices and place orders. Similar to stocks, option price quotes can be found using symbols. Option chains, meanwhile, provide strategists with a wealth of information concerning an options contract. Not only do option chains offer the current market prices for a series of options, but they also provide an options liquidity, the strike prices available, and the expiration months. In fact, option chains are so important that most reputable brokerage firms offer them to their clients with real-time updates. Not long ago, option chains were available mostly to brokerage firms and other professional investors. Today, however, individual investors can go to a number of websites and find option chains. Most online brokerage firms provide them, as do several options-related websites. For instance, at the optionetics.com homepage, pulling up an options chain for any given stock is simply a matter of entering the ticker symbol in the quote box at the top of the screen and selecting Chain. Table 4.4 shows an option chain snapshot of some semiconductor HOLDR's options taken from optionetics.com. Notice first that like any other option chain, it is split down the middle to provide information about both calls and puts. On the left half of the table the call option contracts for SMH are listed, and on the right side, put options are sorted by strike price. Because there are a large number of puts and calls available, understanding options 67 table 4.4 SMH options chain open calls bid-ask interest strike price puts bid-ask interest SMHAD 17.6017.703944 Jan 0620.00 SMHMD 0.000.050100049 SMHAX 15.1015.301966 Jan 0622.50 SMHMX 0.0000504 SMHAE 12.6012.803984 Jan 0625.00 SMHME 0.000.050100014 SMHAY 10.1010.302068 Jan 0627.50 SMHMY 0.000.0501553 SMHAF 7.607.802470 Jan 0630.00 SMHMF 0.000.0505089 SMHAZ 5.205.306394 Jan 0632.50 SMHMZ 0.050.1027431 SMHAG 2.903.0053081 Jan 0635.00 SMHMG 0.200.2573847 SMHAU 1.051.1052177 Jan 0637.50 SMHMU 0.850.9063736 SMHAH 0.200.2584281 Jan 0640.00 SMHMH 2.452.5511857 SMHAV 0.000.0504649 Jan 0642.50 SMHMV 4.805.00126 SMHAI 0.000.0504595 Jan 0645.00 SMHMI 7.307.50183 Source: Optionetics.com. 68. The Index Trading Course. For this fund, it is important to keep in mind that only a fraction of the available options are listed in the table. In this case, the table includes only the January options. The first factor to understand when considering an option chain is the manner in which the options are sorted. Again, calls are generally on the left half of the table and puts are on the right. Each row, then, represents two different contracts. These contracts are first sorted by month. Therefore, at the top of the chart, the front month or the next expiration appears first. Since this option chain was taken December 20, 2005, the front month is January 2006 and it appears at the top of the option chain. February 2006 would appear second, only January is included in this table, and each expiration month available would then follow in order. In the case of SMH, the option chain ends with the January 2008 long-term equity anticipation securities LEAPS with the 45 strike price. Within each month, option contracts are sorted by strike price. The options in this table begin at a strike price of 20 and end with